The tax system that keeps Americans poorer every year. That sounds like hyperbole until you look under the hood. Then it starts to look like design, not accident. The code, the loopholes, the permanent favors, none of it is a spreadsheet error. It's a human artifact. It is the predictable outcome of politics, of lobbyists who treat committees like garages, and of incentives that reward short-term cleverness over long-term value. If you want slow, steady impoverishment for ordinary people, you could hardly do better than this system. Here's the thesis in one line. Politics plus special interests plus perverse incentives equals a tax system that, year after year, shifts burdens away from powerful interests and onto ordinary workers and voters. That shift happens quietly, with plausible deniability, in the seams where law meets bargaining. It is not mysterious. It is not a mistake. It is the result of human incentives doing exactly what they are built to do. If you want the full breakdown, stay with me for the next half hour. I'll walk through how the sausage is made, the way committees and campaigning produce permanent favors, how tax burdens have migrated from corporations to workers, why offshore cash is not an accident but a response to design, and why state-level competition compounds the harm. Along the way, we'll meet the lobbyist, the nervous CEO, the policymaker performing for the cameras, and the ordinary taxpayer left holding a lighter paycheck. I'll also suggest what to fix, practical, incentive-focused ideas, while warning you that human nature will try to re-corrupt anything we build. Let's start with how laws get baked. Sit in a committee hearing and you'll see the economy of performance. Politicians need votes, and votes are a bundle of interests. Home state jobs, corporate headquarters, unions, donors, retirees, and the local paper. No committee chair stands up and says, "Let's have a clean code that treats everyone the same." That would be political suicide. Instead, legislation gets built piece by piece. Someone promises a credit to a rural manufacturer for a job program. Another wants a tweak that helps passes for a favored industry. Meanwhile, representatives need to show movement, photos, press releases, applause on the floor. The practical result is a law that is a quilt of temporary patches, meant to be temporary until the next bill, but once sewn in, they rarely come out. Think of those carve-outs as barnacles on a hull. The ship sails fine with the occasional hitch, but over time, the hull gets fouled. Each barnacle is small, a deduction here, a credit there. Each seems justifiable on its own. But barnacles do not detach themselves. Special interest groups, lawyers, lobbyists, trade associations, spend their summers not only advocating for new favors, but defending the old ones. Once you give someone a tax advantage, it becomes a creature with teeth. They hire counsel, they create narratives about jobs and innovation, and they make it politically costly to remove the privilege. There's a second dynamic that makes these barnacles permanent: performance politics. Congressmen and governors need to be seen doing something. Televised hearings, ribbon cuttings, and the occasional stern press conference about unfair taxation give the illusion of control. The voters see action, the politicians get headlines, the underlying incentives that created the carved-out favor are never addressed. Instead, we get another layer: temporary language to appease critics, temporary funding to smooth the blow, an exception so complicated that only a handful of highly paid accountants and lawyers can navigate it. Complexity breeds rent-seeking because complexity creates opportunities for specialists to extract value. So, why does this make Americans poorer? Because the obvious way to keep the system running is to shift revenue collection away from those with influence and towards sources that are harder to shield, chiefly ordinary wages and consumption. Corporate tax receipts as a share of the economy have declined, while the share coming from payroll and worker-side levies has not fallen in the same way. To be clear, per the commentary that frames this discussion, Corporate tax as a percentage of GDP has been cut roughly in half over the decades. That's a claim about broad trends, not a precise mathematical declaration here and now. And it matters because it changes who picks up the tab. When the corporate tax bite shrinks, the budget still needs revenue. What fills the gap? Payroll taxes, fees, and taxes that are harder to move. Employers can shift costs, companies can redesign corporate structures, and wealthy individuals can reorganize to avoid state-level or federal-level burdens. The people who cannot easily flee are those earning wages from a single employer, retirees on fixed incomes, renters, and small business workers tied to local economies. The net effect? The tax burden migrates down the ladder. The wealthy and powerful find ways around the tax. Ordinary workers have to bear relatively more. That's how a system, over years, makes the middle class a bit poorer each cycle. Let me give you a simple picture. Imagine a company that reports a profit on paper but has a phalanx of lawyers and tax teams protesting that its final tax bill is much smaller than a naive calculation would suggest. In parallel, a nurse or a teacher sees the same nominal wage but more withheld, or more of their take-home diverted to payroll taxes and premiums. The individual is not necessarily getting a pay cut, but their real after-tax, after-fee consumption declines relative to what might be the case under a cleaner system. Over time, with compounding, those are not small ripples. Now, people complain about corporate taxes all the time. CEOs appear in the papers with pained expressions. "We need lower taxes," they say. But there's a bit of theater in that complaint. As stated in the commentary that informs this piece, corporate taxes as a share of GDP have fallen, even while corporate profits and executive compensation have gone up. The moral theater is useful for politicians looking for scapegoats and useful for CEOs looking for cover. It's easier to campaign against a corporate tax than to explain that many companies pay effective rates far below statutory levels because of lobby-crafted incentives, international loopholes, and the machinery of tax planning. Which brings us to offshore cash. You've heard the figure, a couple of $1 trillion parked overseas. Per the original commentary, the oft-cited number is around $2.1 trillion sitting offshore. That cash isn't trapped by a mysterious force. It's there because the system makes repatriation expensive. If a multinational brings foreign earnings home, it often triggers tax events. So firms respond predictably. They keep the money where it is, or they invest it in financial engineering rather than productive domestic capital expenditure. It's exactly what incentives would produce when you create a penalty for doing something you nominally want companies to do, like bringing profits back to the homeland. We should be careful here about motive. Companies are not monolithic villains. Many executives genuinely believe that minimizing tax liabilities is part of their fiduciary duty to shareholders. But when fiduciary duty is framed narrowly around quarterly earnings and stock price, the longer-term interests of the economy, steady employment, investment in plant and training, sustainable research, get subordinated. Boards pressured to meet short-term earnings targets will applaud whatever legal maneuvers reduce the tax bill now. The organizational incentives reward ingenuity in tax avoidance, not necessarily investment in the domestic workforce. A brief anecdote. I recall a firm where a department head quietly suppressed an insurance claim that would have disturbed the earnings pattern for the quarter. The rationale was painfully mundane. A single bad quarter would spook analysts, depress the stock, and threaten the bonuses of senior managers. So the claim sat in a desk drawer until it could be processed in a quarter when the numbers could absorb it. That's not high drama. It's human caution. But aggregated across millions of small choices, it repeats into systematic behavior. When companies are rewarded for hiding volatility, they'll hide it. When they are rewarded for squeezing taxes out of the system, they'll squeeze them. The system makes this not only plausible, it makes it optimal. Warren Buffett has often offered a more practical take. Taxes should be fair and rules should be simple. Berkshire Hathaway can survive and thrive under higher statutory rates because its people focus on long-term value. That point matters. If the headline corporate tax rate is high, but the system has loopholes engineered by the well-connected, what matters is the effective rate, the rate actually paid after deductions and credits. You can have a high headline and a low effective rate simultaneously. That mismatch, per the commentary, explains much of the grievance-laden rhetoric you hear from CEOs and trade groups. Let's be explicit. This is not an academic quibble. When corporations have incentives to keep money offshore, citizens lose. Not necessarily in immediate, dramatic ways you can point to with a single stat, but in slower, more insidious ways. Less investment in worker training, more pressure on wages, and a thinner tax base for public goods. Over time, public infrastructure decays, schools are underfunded, and safety nets shrink. Those are real costs. They are not always captured in GDP swings because GDP can look healthy while distribution shifts. Yet, for a family budgeting for the mortgage and the kids' college, those distributional shifts feel like a steady weakening. Now, politics responds, but not always in helpful ways. Policy debates are theater. Think of tax reform as a circus tent. The politicians are the ringmasters. Every few years, there's a big show. Promises are made. Simplification, fairness, relief for the middle class. The tent flaps around these promises for a while, but the rigging, the coalitions, and the pork remains intact. What the public sees is a headline, tax reform that helps families. What the insiders see is a chance to move language and protections into permanent law, or to create new exceptions that later morph into defaults. The moral, public-facing reform is often less about fixing incentives and more about redistributing them to favored constituencies under cover of change. One of the reasons this is so stubborn is the mismatch between who benefits from complexity and who pays the cost. The beneficiaries are concentrated: corporations, wealthy individuals, sectors that need a specific loophole. Concentrated benefits attract organized lobbying. The costs are dispersed across millions of workers and consumers who have less reason or capacity to organize against specialized interests. That asymmetry is not incidental. It is the engine of redistributive drift. Over time, policies that benefit the few consolidate. Policies that would benefit the many are starved of political energy. A few concrete mechanisms show how the system channels incentives into outcomes. First, carve-outs and credits. Give a deduction to a specific industry and you create a constituency. Those constituents will defend the deduction with a fervor that often outstrips the original justification. Second, international tax rules. Allow companies to defer taxes on foreign earnings and you create offshore hordes. Third, state competition. Let states lure businesses with tax breaks and you set off a race to the bottom. Each mechanism makes the federal or state tax base thinner, and the remaining revenue must come from sources that are harder to hide, like wage withholding or sales taxes. I want to spend a moment on state-level dynamics because they illustrate an important constraint. People and capital move. If one state raises taxes on the wealthy or on corporations, high-income individuals and firms may relocate their legal residence or operations. That mobility chips away at the local tax base. You cannot pretend that state-level policy decisions operate in a vacuum. Per the commentary, the contrast between high-tax places and low-tax havens creates a migratory incentive that punishes states with higher levies, especially on the wealthy and highly mobile. The policy implication is tricky. If you try to tax the rich out of the state to fund services, those services may shrink as the tax base migrates. That doesn't mean you should never tax the well-off, just that the design must account for mobility and be careful not to create incentives for flight. Consider California as an example. High taxes, expensive housing, and a complex regulatory environment create both a formidable revenue engine and a pressure valve. Some high earners and entrepreneurs look across the border at states with lower rates and decide the arithmetic favors moving. The state then confronts a shrinking income tax base at the margin, particularly for the very wealthy. The public sees declining revenue growth for public goods and panics. The policy response oscillates between raising rates, which risks further flight, and cutting services, which harms the middle class and the vulnerable. It's not a simple game. Of course, some will say, let the states compete. It disciplines government. There's logic in that. Competition can be healthy, preventing governments from overreaching. But competition also has consequences. If every state tries to attract investment by offering tax incentives, everyone ends up offering them, and the collective result is lower revenue for the same or lower public goods. It's a prisoner's dilemma. Individually rational choices offer the incentive to get the jobs, aggregate into a collectively worse outcome, a decline in the capacity to fund education, infrastructure, or public safety. Back to the federal level. There's a behavioral and organizational layer that often gets missed in policy discussions. Laws and statutes matter, but so do the incentives inside firms and agencies. Accountants, auditors, executives, and managers respond to the reward structure. If your bonus depends on beating earnings estimates, you have an incentive to manage earnings, sometimes aggressively. If your professional reputation is built on cutting tax liabilities, you'll invest resources in finding new avenues to do so. If legislators are judged by whether they can get something for their district, they'll fight for carve-outs. The Oren story captures this well. A claims adjuster in a mid-sized insurer noticed a pattern. Small claims were being slow-walked until quarterly numbers looked better. He documented it and raised his hand. Management's reaction was not to fix the incentive, it was to shuffle paperwork and hope the auditors didn't notice. That is not an unusual reaction. Organizations are conservative in the face of disruption. Change the incentive and you change behavior. But people cling to incentives because they are familiar and because they have winners attached to them. Right now, in the world of tax policy, the incentives are structured so that good lawyering is rewarded and shoddy public infrastructure is tolerated. The brilliant tax attorney who finds an obscure provision to slash a bill is praised by the client and paid handsomely. The public sector worker who warns that a loophole will hollow out the educational budget finds fewer fans. Over time, the incentives shape those who populate the roles. Talented people flow to the places where their talents are most rewarded. This is one of the key lessons. Systems reward certain behaviors, and people adapt to those rewards. Change the reward, and you change the behavior. The challenge is that changing rewards in the tax system is hard, because those who benefit from the current design are well organized and well resourced. They can hire lobbyists, donate to campaigns, and exploit media narratives. The diffuse majority, workers who lose a bit of purchasing power each year, are less likely to mobilize in sustained ways. So, if the system keeps Americans poorer, what does it look like on a typical household level? It's not necessarily a headline recession. It is a slow tightening. Higher premiums, slightly higher withholdings, a tax credit that vanished 2 years ago and now no longer gives relief, a state that reduced contributions to schools because the wealthy left. Compounded over decades, these small erosions translate into significant disparity. At the same time, the public conversation is distorted. Powerful actors complain about their marginal tax rates while benefiting from shelters and maneuvers that ordinary citizens cannot access. It creates a narrative of grievance that masks the actual distributional shift. Complaints become performative. Shout about high taxes, lobby to replace direct taxes with credits that primarily benefit certain industries, then celebrate when headline rates fall, even if effective rates for many of your campaign donors fall further than for the public. The result is a code that looks simpler on paper, but in practice concentrates advantage. By now, you might be asking, if the system is this responsive to incentives, what are the policy levers that will actually help? I'll get to that in time, but first, one more clarification. When I talk about incentives, I'm not merely criticizing human greed. Incentives are the mechanism through which institutions function. People respond to them because that's how organizations and societies coordinate action. The problem comes when incentives favor rent-seeking over productivity. The tax code today contains many such incentives. Some were designed with a rationale: promote home ownership, encourage investment. But the cumulative effect is a landscape of favored treatments that have become entrenched. Undoing that entrenchment requires not just good policy, but political courage and institutional design that resists capture. Before moving on to solutions, I want to dwell for a minute on one other aspect: narrative and blame. It is useful politically to point at numbers and declare that one group or another is getting away with something. But the deeper truth is structural. Sure, there are bad actors, call them what you like, but they are operating inside a machine that rewards their behavior. Blame is satisfying. Redesign is less so. It requires acknowledging trade-offs, making hard choices about who will lose privileges, and building enforcement mechanisms that deter recreation of loopholes. That brings us to the most uncomfortable part of reform: human nature. Even a well-crafted code will face determined efforts at re-corruption. Lobbyists will find ways to bend language. Lawyers will construct ingenious interpretations. CEOs will push for whatever reduces their pressures. That is why any reform must not be a single one-time event. It must involve continuous defense, auditing, transparent reporting, penalties for abusive avoidance, and a political culture that prizes fairness over short-term headline gains. We're at the point where the analysis has to grow practical. I will, in the next section, break down specific mechanisms, how particular tax provisions function in practice, how offshore structures work in more detail, and how state competition translates into revenue shortfalls for essential services. I'll also walk through modest, incentive-aligned reforms that could blunt this steady impoverishment: simplification where possible, eliminating targeted carve-outs that no longer serve a clear purpose, tightening international tax rules so repatriation is not penalized, and designing state-level compacts to limit destructive competition. But before that, one more brief story to keep the human stakes in focus. A mid-sized manufacturing town I know once prospered because a factory paid good wages and the tax base supported schools and roads. Over time, that factory reorganized. Some functions moved offshore. The company took advantage of credits and loopholes the local community didn't know existed, and the factory's effective tax contributions declined even as its accounts showed profits. The council cut services. Families moved because the schools declined. The town's civic life frayed. The change did not happen in a single headline. It happened in 100 small shifts: concessions in exchange for jobs, credits offered to keep a plant open, and a steady attrition of public investment. The people most affected were not the ones lobbying in Washington. They were the neighbors paying increased payroll levies or higher local fees. This is the practical harm. It is not dramatic, it is cumulative, and it explains why a tax system designed, or rather evolved, through human bargaining and opportunism can make ordinary Americans poorer year after year. Now we turn from diagnosis to the anatomy of specific mechanisms. First, I'll walk through a tighter look at corporate taxation, statutory rates versus effective rates, the role of deductions and credits, and the logic behind keeping profits offshore. Then I'll examine payroll-based burdens and how they fall heavily on wages. After that, we'll move to states, the choices that California and others face, and why mobility of people and capital limits policy options. Finally, I'll sketch reforms that deal with incentives rather than intentions. But before I open those chapters, remember the engine. When law meets human incentives, the humans organize around what benefits them. That's not a moral indictment so much as a practical prediction. Design with that in mind or expect the system to be gamed. We begin with the corporate side. Consider the difference between the headline corporate tax rate and what corporations actually pay. The headline rate is easy to report in a 10-second soundbite. The effective rate, the percentage firms pay after deductions, credits, and international adjustments, is what shows up when you count the actual receipts. Per the commentary that informs this piece, the share of GDP coming from corporate taxes has fallen materially over recent decades. That doesn't necessarily mean corporations are paying no taxes, just that the balance has shifted. One reason is that the code is full of incentives for particular behavior. Accelerated depreciation, tax credits for certain investments, and loopholes that favor intangible income are all rationalized as economic policy. But they also function as channels through which well-advised firms reduce tax burdens and through which certain industries receive windfalls. The political bargains that created these provisions made sense in their moment. The problem is they persist long after their ostensible rationale has faded. Then there's the international dimension. If a firm can legally defer U.S. tax on foreign earnings until repatriation, it often chooses to keep those earnings where they are, if repatriation would incur tax. Cash earns a certain return offshore. Clicking a button to move it home can trigger a tax liability. So companies structure operations to keep money stationed in low-tax jurisdictions, or they recharacterize earnings in ways that reduce the U.S. bill. This behavior is rational given the rules. Change the rules so repatriation is neutral or mildly encouraged, and you change the behavior. But changing rules is hard. The political incentive to create exemptions for particular firms or sectors is strong. At this point, you might feel the narrative is bleak. It is. But it is also useful, because a clear diagnosis points to the right kind of remedy. Not slogans, but incentive changes. Repeal a carve-out and demand clarity about its purpose. Close a loophole and set guardrails to prevent a new one from popping up. Recalibrate international tax rules to avoid punitive repatriation taxes. Make reporting transparent so the public sees who benefits. These are not overnight cures. They are steady work, and they require guardianship. People and institutions committed to defending the public interest. We'll get to the detailed prescriptions and trade-offs. For now, keep in mind the through line. Complexity plus concentrated benefits plus mobility equals a system that, gradually and predictably, redistributes burden away from the influential and onto the less mobile. That redistribution is the mechanism by which the tax code makes Americans poorer each year. Next, we'll parse payroll taxes and worker-borne levies, how they rise, why they are regressive in practice, and what that does to take-home pay. Then we'll move to the state competition dynamic in depth, a crucial piece because policy cannot ignore the fact that people and capital can and do move. Next, payroll taxes and the quietly regressive tilt of the system. Payroll levies are the sort of tax that looks boring and technical until you notice who really bears them. Employers and employees split certain charges on paper. In practice, the incidence tends to fall on wages because labor is less mobile than capital. Firms can automate, offshore tasks, or reclassify income. Workers who show up to the same job each month cannot, with a snap, reclassify their salary as capital gains. The consequence is predictable. When the headline corporate bite shrinks, government still needs revenue, and it reaches for what it can reliably collect. Payroll taxes, fees, and consumption taxes fit that description. They are steady and hard to dodge. And when you levy more from that base, the result is a thinner paycheck for ordinary people. I'm not saying payroll taxes are inherently illegitimate. They fund Social Security and Medicare components that matter. But here's the point. The shift toward worker-borne levies is not neutral. It redistributes the tax burden downward because of mobility differences and the political realities of concentrated lobbying. You see it in a dozen small ways. A restaurant owner finds that payroll costs climb, so he reduces hours. A small manufacturer restructures a job into a contract to avoid withholdings. A teacher sees a larger slice removed for a pension obligation that the school district previously matched. None of these is dramatic by itself. Stacked together over decades, they cumulatively reduce consumption and investment capacity among middle and working class households. That is one clear channel by which the tax system makes Americans poorer year after year. Let me give an anecdote that puts a face on the math. A small business baker in a Midwestern town expanded to a second storefront. The book suggested it could support 4 new hires. But as payroll costs, unemployment insurance rates, and fringe obligations rose, either through legislated increases or through hidden local assessments, the owner made a practical choice. Hire 2 full-time and 1 part-time rather than 4 full-timers, and subcontract the rest. The neighborhood still had jobs, but fewer with benefits and career ladders. The town's tax base shifted slightly. The baker's revenue flashed on a profit and loss sheet, but the distribution of gains changed. Not a scandal, not a drama on the evening news, just a modest, incremental tightening. Multiply that pattern across thousands of firms, and the aggregate effect is meaningful. Now turn to state-level competition, because it amplifies everything I've described. Mobility matters. Capital migrates to lower taxes. High-income earners relocate when the arithmetic favors it. States are not islands. If one state decides to tax taller pines more heavily, the pines sometimes move to a sunnier plot of ground. As described in the commentary framing this piece, places with high headline rates, California is the common example, face both benefits and risks. They generate significant revenue when the base is present, but they also create an incentive for the most mobile actors to depart. Florida, Texas, and a handful of others advertise low or no personal income tax as a lure. That migration is not always popular or easy. It often involves families, payroll retooling, or legal moves. But for high earners and footloose firms, the calculus can be decisive. This creates a political trap. A state raises rates to fund schools, transit, and public safety with the goal of preserving a middle-class quality of life. At the margin, a few high earners or corporate headquarters may head for lower-cost pastures. The state then faces 2 painful choices: accept lower revenue and cut services, or hike rates on the remaining base, risking further departures. That's the dynamic that erodes local public goods over time. Again, it's not dramatic unless you live in the affected community. For the family whose school budget is cut, the result is painfully real. A short, sharp example. An entrepreneur I know moved her startup from a high-tax jurisdiction to a lower-tax one. She was not fleeing virtue or fleeing civic duty. She was balancing payroll costs, private investor expectations, and personal tax exposure. The move saved the company money in the near term and made the cap table look cleaner for future fundraising. For her old hometown, the departure took away payroll taxes and local spending. Those losses translated into deferred roadwork and a slimmer parks budget. The entrepreneur prospered, the town's ability to maintain infrastructure waned. This is not a moral condemnation of the entrepreneur. Market actors make rational choices. It is a structural observation about the incentives that tax policy creates. State competition has a second bite, an incentive arms race. If one state offers a tax break to attract a factory, a neighbor state responds in kind. Elected officials trade off short-term job announcements for long-term penury. Those job announcements look great on a campaign flyer, but the fiscal math often does not. Tax incentives are expensive and often poorly targeted, concentrated benefits given in the name of public benefit. Over time, the aggregate effect is a thinned tax base and weaker public services, which again hurts ordinary Americans most. I'll be blunt. If you want to keep services robust in a competitive federation, you must design rules that internalize the externalities of tax competition. Otherwise, everyone's left with less. That's easier said than done. It requires political will and interstate coordination, which is precisely what the most mobile and well-resourced actors have little interest in sustaining when they benefit from the current playbook. We've covered mechanisms: the political sowing of carve-outs, the shift of incidence to workers, offshore incentives, and state-level flight. Now let's talk about behavior inside organizations, because systems don't just change laws, they change choices. Incentives inside firms shape hiring, investment, reporting, and sometimes dishonesty. When executive compensation, analyst expectations, and short-term stock price movements dominate the reward structure, managers react predictably. They find legal ways to reduce tax bills, they manage earnings, they delay maintenance, they substitute buybacks for capital spending when that's what pushes the stock. Again, these are rational acts given the incentives. The misalignment is not a mystery, it's a design flaw. There's a story that captures this greed not as villainy, but as prediction point. A mid-cap company, public and well-reported, spent millions on lobbying for a new credit that would favor their industry. The credit passed. The company then announced a modest increase in domestic investment, enough to justify the credit in press statements. But most of the financial benefit flowed to shareholders in the form of buybacks and to executives in the form of bonuses tied to earnings per share metrics. The local community saw a ribbon cutting and a fine photo op. The local paper praised the jobs announcement. But the long-term investment that would have strengthened the wage base and created stable career ladders was modest. The firm had, in effect, converted a public subsidy into private financial engineering. It's an old trick. Use public incentives to reallocate value into forms that theater and sound bites make palatable while delivering limited, sustained benefit to the workforce. How do we fix behavior? You change the incentives. Pay executives for long-term performance measured by real metrics like workforce retention, capital spending, and product innovation, rather than quarterly earnings. Reward boards that adopt rigorous long-term metrics with tax treatment that recognizes stewardship. But remember the caveat. As soon as you create any reward, someone will lobby to convert it into a specialized favor. So design must be paired with transparency and guardrails. That brings us to reform prescriptions: practical, incentive-focused, and politically savvy. The recommendations here are not sexy. They are the kind of boring, detail-heavy ideas that, if implemented, would reduce rent-seeking over decades. They also require constant maintenance because the adversary is human nature, the tendency to recreate the advantages. 1. Broaden the base, lower rates. This is an old line because it works. A tax system with fewer carve-outs and a broader taxable base allows lower headline rates that are harder to avoid. When deductions and credits vanish or are trimmed, shelter opportunities shrink. The political problem? Any politician who votes to eliminate a local carve-out will face a concentrated interest group angrier than the diffuse majority that benefits from the savings. The practical response is to phase reforms with clear sunsets. Carve-outs that arrive with mandatory expiration unless actively renewed force politicians to make the case publicly rather than letting privileges calcify by default. 2. Neutralize repatriation incentives. If you want multinational firms to bring cash home, make repatriation neutral, not punitive. If bringing foreign profits home triggers a tax penalty, firms will keep them offshore. Per the commentary, there is a large stock of corporate cash abroad, around $2.1 trillion as often cited. And that is a policy choice, not a mystery. A neutral regime encourages genuine reinvestment rather than financial legerdemain. The devil, of course, is in the details. You need rules that prevent immediate gaming and that require transparency on how repatriated funds are used. 3. Increase transparency and reporting. Sunlight is a deterrent. Require country-by-country reporting for multinationals. Make effective tax rates visible, not headline rates. Publicly disclosed effective rates make it easier for shareholders, journalists, and regulators to spot abusive structures. Transparency reduces the information asymmetry that lobbyists and corporate counsel exploit. 4. Institute automatic sunsets and simple default rules. One reason barnacles accumulate is because temporary measures are allowed to calcify. If credits and carve-outs come with automatic expiration, the political cost of renewal becomes explicit. Make simplicity the default. The town, having invested budgetary leverage in attracting the employer, roads, training programs, enhanced services, found itself with less revenue when it needed more. The short-term win became a long-term vulnerability. That story repeats across many localities. It's another example of how incentives shape choices long after the press photo is taken. Let me close the circle and return to our title. Tax System That Keeps Americans Poorer Every Year, Charlie Munger. That is not a punchy slogan. It is a diagnosis. A tax code shaped by politics, special interest bargaining, and perverse incentives will, over time, redistribute burden away from the well-connected and toward the less mobile. The process is quiet and cumulative, which is why it eludes easy outrage. It is also why we need institutional discipline, simplification, transparency, neutral repatriation, interstate coordination, and enforcement. These steps don't guarantee instant prosperity, but they reduce the structural drag that makes ordinary people poorer year after year. If you want one line to carry home, money plus politics plus human nature equals a system that steadily reallocates advantage. That's the Munger rule, distilled. Design matters, incentives dominate, and vigilance is the price of fairness. If this argument resonated, there's more detail in the full write-up linked below. Read the detailed breakdown for a closer look at mechanisms and trade-offs. And if you found this useful, share it with someone who thinks taxes are just arithmetic. Encourage a more civil discussion about incentives, not just slogans. If enough people insist on clarity and long-term thinking, the political equilibrium shifts. Thanks for staying with the argument. The work ahead is practical and unglamorous, but if your goal is to stop a system from making ordinary Americans poorer, the next step is always to change the incentives.